time. Chart patterns are the cornerstone of technical analysis, giving traders the ability to predict market movements with greater accuracy. Today, we're diving into the most essential chart patterns that can shape your trading strategy and improve your ability to anticipate market shifts. Understanding these patterns isn't just about recognizing shapes on a chart. It's about interpreting the story the market is telling you. Every pattern reflects the battle between buyers and sellers, and knowing how to read these patterns gives you an edge in predicting what comes next. Let's start with some key patterns that every trader should be familiar with. The head and shoulders pattern, for instance, is one of the most reliable indicators of a trend reversal. It forms after an uptrend and signals that the momentum is shifting from bullish to bearish. Picture this: the market reaches a peak, then pulls back, rises to an even higher peak, pulls back again, and then rises to a lower peak. This sequence forms the shape of a head and two shoulders on the chart, indicating that the uptrend is weakening and a downtrend is likely to follow. Traders who can spot this pattern early can position themselves to take advantage of the impending downturn. Another powerful pattern is the double top. This one is simple yet effective. It occurs when the price of an asset peaks, pulls back, and then returns to the same peak level, only to fail and fall back again. The double top suggests that the asset has reached a strong resistance level and is unable to break through, which often leads to a significant downward movement. Recognizing a double top early allows traders to short the asset or exit long positions before the market declines. On the flip side, there's the double bottom pattern, which signals a potential upward reversal. The double bottom forms after a downtrend where the price hits a low, rebounds, and then retests the same low before moving higher. This pattern suggests that the market has found a strong support level, and the sellers have exhausted their pressure, making way for the buyers to take control. Spotting a double bottom can be a great opportunity to enter a long position before the market begins to rally. Beyond these classic patterns, there are other formations like triangles and flags that indicate continuation rather than reversal. For example, when the market forms a symmetrical triangle where the highs and lows converge towards each other, it often signals a period of consolidation before the price breaks out in the direction of the existing trend. Knowing how to trade these patterns can help you stay on the right side of the market momentum, capturing profits as the trend resumes. Volume is another crucial aspect when interpreting chart patterns. A pattern confirmed by strong volume carries more weight than one with weak volume. For instance, if a head and shoulders pattern forms, but the volume spikes significantly on the breakout, it's a stronger signal that the trend reversal is genuine and not just a false move. Incorporating diverse technical indicators alongside these patterns can also enhance your analysis. Bollinger Bands, for example, can help you gauge volatility, while moving averages provide insight into the overall trend direction. Combining these tools with chart patterns allows you to build a more comprehensive trading strategy, giving you multiple points of confirmation before making a move. As you continue to study and apply these chart patterns, you'll develop a deeper understanding of market psychology and how it influences price action. This knowledge is invaluable for making informed trading decisions, whether you're day trading or holding positions for the long term. The key is to practice recognizing these patterns in real-time charts and backtest your strategies to refine your approach. With time and experience, you'll become more adept at using chart patterns to predict market movements and achieve greater success in your trading endeavors. Let's dive into some key chart patterns, how to trade them effectively, and the essential order types like stop loss and market limit orders that can protect your investments and optimize your trading strategy. Understanding these patterns isn't just about recognizing them on a chart. It's about knowing how to act when they appear and how to use the right tools to execute your trades with precision. Chart patterns like the head and shoulders, double tops, and double bottoms are among the most reliable indicators of market reversals. When you spot a head and shoulders pattern, it's signaling that an uptrend may be nearing its end. This pattern, with its characteristic 3 peaks, suggests that the buying pressure is weakening and a downward move could be imminent. Once you've identified this pattern, the next step is to position yourself to take advantage of the upcoming trend reversal. You can enter a short position just below the neckline of the pattern, anticipating the drop. On the other hand, double tops and double bottoms provide clear signals of potential reversals as well. A double top, which occurs when the price fails to break through a resistance level twice, is a strong indicator that the market is about to head lower. Similarly, a double bottom, where the price tests a support level twice before rising, indicates a potential upward reversal. Trading these patterns involves entering at the point where the price confirms the reversal, giving you the opportunity to ride the new trend from the beginning. To manage these trades effectively, using order types like stop loss and market limit orders is crucial. A stop loss order automatically sells your position if the market moves against you, limiting your potential losses. For instance, if you enter a trade after spotting a double top and set a stop loss just above the second peak, you protect yourself in case the market doesn't move as expected. This simple yet powerful tool helps you safeguard your capital and stick to your trading plan, even when the market is volatile. Market limit orders, on the other hand, allow you to set a specific price at which you want to enter or exit a trade. This ensures that you don't pay more or receive less than your desired price, adding another layer of control to your trading strategy. For example, if you've identified a potential reversal and want to enter the market at a precise point, a market limit order lets you do just that, ensuring you execute the trade only at your chosen price or better. Mastering these chart patterns and understanding how to use stop loss and market limit orders can significantly enhance your trading strategy. They not only help you make more informed decisions, but also ensure that your trades are executed with the precision and control needed to navigate the complexities of the market. As you continue to refine your skills, you'll find that these tools become an integral part of your decision-making process, helping you to trade more confidently and effectively. The head and shoulders pattern is a powerful signal of a trend reversal and is considered one of the most reliable patterns in technical analysis. It's a classic formation that traders look for when trying to anticipate a shift in market direction. This pattern consists of 3 distinct peaks. The middle peak, known as the head, is the highest, while the other 2 peaks on either side, called the shoulders, are slightly lower. The head and shoulders pattern typically forms after an extended uptrend, signaling that the market's bullish momentum is weakening and that a reversal to the downside is likely on the horizon. As the price reaches the first peak, or the left shoulder, it pulls back slightly before pushing higher to form the head. After hitting this highest point, the price pulls back again, only to make another attempt to rise, forming the right shoulder. However, this time, the price fails to reach the height of the head, indicating that the buyers are losing strength. The key to this pattern lies in the neckline, which is the level of support or resistance that connects the lows between the head and the shoulders. Once the price breaks below the neckline, It confirms the pattern and signals that a bearish reversal is underway. Traders often look to enter a short position just as the price breaks below this neckline, aiming to capitalize on the downward move that typically follows. Recognizing the head and shoulders pattern early can give you a significant advantage, allowing you to anticipate market reversals and adjust your trading strategy accordingly. Whether you're looking to protect your gains from an uptrend or position yourself for the ensuing downtrend, this pattern offers a clear and reliable signal that the market is about to change direction. Double tops and double bottoms are key indicators of potential reversal points in the market, providing traders with valuable signals that the current trend may be nearing its end. These patterns are straightforward to recognize and can be powerful tools in your trading arsenal. A double top forms after an uptrend and is characterized by two peaks at roughly the same price level, creating a shape that resembles the letter M. The pattern suggests that the market has hit a strong resistance level, making it difficult for the price to break through. After reaching the first peak, the price pulls back slightly, only to attempt another push higher. However, when the price fails to surpass the first peak and retreats again, it signals that the buying momentum is fading and that a reversal to the downside is likely. Traders often look to enter a short position as the price breaks below the support level formed by the lows between the two peaks, anticipating a further decline. On the other hand, a double bottom forms after a downtrend and looks like the letter W. This pattern indicates that the market has found a strong support level, preventing the price from falling further. After hitting a low, the price rebounds but then retests the same support level. When the price fails to break below this level and begins to rise again, it signals that the selling pressure is weakening and that a reversal to the upside may be on the horizon. Traders often enter a long position as the price breaks above the resistance level formed by the highs between the two troughs, positioning themselves to benefit from the upward move. Both double tops and double bottoms suggest that the market is struggling to continue in its current direction and is likely to reverse. By recognizing these patterns, traders can better anticipate shifts in market momentum and make more informed decisions about when to enter or exit trades. These patterns are not just indicators of possible reversals, but also provide clear entry and exit points, helping traders to optimize their strategies and enhance their overall trading performance. Triangles are powerful chart patterns that suggest a period of consolidation before the market makes a decisive move. Whether ascending, descending, or symmetrical, these patterns can provide valuable insights into potential breakouts and help traders prepare for significant market shifts. An ascending triangle forms when the price makes a series of higher lows while consistently hitting resistance at the same level. This pattern is typically seen as bullish because the higher lows indicate that buyers are gaining strength and are increasingly willing to purchase at higher prices. As the pressure builds, the price is likely to break through the resistance level, leading to a strong upward move. Traders often look to enter a long position just as the price breaks above the resistance, anticipating that the breakout will lead to further gains. In contrast, a descending triangle forms when the price makes lower highs, repeatedly finding support at the same level. This pattern is usually considered bearish, as the lower highs suggest that sellers are becoming more aggressive, pushing the price down. The market seems to be losing its upward momentum, and the price is likely to break below the support level. Traders typically enter a short position when the price breaks below this support, expecting the downward move to continue as the selling pressure increases. A symmetrical triangle is different from the other two, as it indicates a market that is undecided, with the price making lower highs and higher lows. This pattern reflects a state of equilibrium between buyers and sellers, with neither side having a clear advantage. As the triangle narrows, the market is consolidating, and a breakout in either direction becomes increasingly likely. The direction of the breakout is often uncertain, making it crucial for traders to wait for confirmation before committing to a trade. Once the price breaks out of the symmetrical triangle, traders can follow the direction of the breakout, entering a long or short position accordingly. In all three types of triangles, the key is to recognize the pattern early and prepare for the breakout. These periods of consolidation often precede significant moves, and by understanding the dynamics of each triangle, traders can position themselves to capitalize on the market's next big move. Whether you're dealing with an ascending, descending, or symmetrical triangle, these patterns provide clear signals that can enhance your trading strategy and improve your ability to anticipate market behavior. Flags and pennants are essential short-term continuation patterns that signal brief pauses in the market before the prevailing trend resumes. These patterns often appear after a sharp price movement and can be powerful indicators that the trend has more momentum to continue. A flag forms when the price makes a strong move, either up or down, and then enters a period of consolidation. This consolidation takes the shape of a small rectangle or parallelogram that slopes against the direction of the trend. For example, in an uptrend, the flag will typically slope downward, indicating a brief pullback before the upward trend resumes. The opposite is true in a downtrend, where the flag will slope upward. This pattern reflects a temporary balance between buyers and sellers, but the prevailing trend remains intact. Traders look to enter the market when the price breaks out of the flag in the direction of the original trend, often signaling the continuation of the sharp move that preceded the flag. On the other hand, a pennant resembles a small symmetrical triangle and also forms after a significant price move. Like flags, pennants are continuation patterns that indicate a brief period of consolidation before the trend resumes. The pennant forms as the price moves within a narrowing range, creating a small triangle that appears after a steep rise or fall in price. This pattern suggests that the market is taking a breather, with buyers and sellers momentarily in balance before the next big move. The breakout from a pennant typically occurs in the direction of the preceding trend, and traders often enter a position at this point, anticipating that the sharp move will continue. Both flags and pennants are characterized by their short duration and the sharp price movement that precedes them. These patterns are valuable for traders who want to catch the continuation of a trend with minimal risk. Recognizing these formations on a chart allows traders to take advantage of the brief pause in the market, positioning themselves for the next leg of the trend with confidence. Whether it's a flag or a pennant, these patterns are clear signals that the market's momentum is likely to carry forward, offering opportunities for strategic entries in the direction of the prevailing trend. Spotting these patterns early can give you a significant trading edge, allowing you to position yourself before the market makes its next move. The key is to stay vigilant and look for the specific shapes and formations we've discussed, whether it's a flag, pennant, triangle, or head and shoulders pattern. Recognizing these patterns as they develop on a chart can help you anticipate market movements and plan your trades with greater precision. When you spot a flag or pennant, remember that these patterns typically signal a brief pause before the trend continues. Once the consolidation phase is complete, the market is likely to break out in the direction of the original trend. The best time to enter a trade is right as the price breaks out of the pattern. For a flag, this means buying if the breakout is upward or selling if it's downward. With a pennant, the strategy is similar to the market in the direction of the breakout, capitalizing on the continuation of the trend. For patterns like the head and shoulders or double tops and bottoms, these are more about trend reversals. When you identify a head and shoulders pattern, prepare to enter a short position just as the price breaks below the neckline, signaling that the uptrend is likely over. Conversely, with a double bottom, you'd look to enter a long position as the price breaks above the resistance level, indicating the start of a new upward trend. Triangles, whether ascending, descending, or symmetrical, require you to watch closely as the price approaches the apex. The breakout direction, whether above resistance or below support, will determine whether you go long or short. The key with triangles is to wait for confirmation, breakout with strong volumito, avoid false signals. In all cases, using stop-loss orders is essential to managing risk. Place your stop-loss just outside the pattern to protect yourself if the breakout fails or the market moves against you. This way, you can limit potential losses while giving your trade room to work. Trading these patterns effectively requires practice and discipline. By consistently looking for these formations and understanding how they indicate future market movements, you can refine your strategy and improve your decision making. The earlier you spot these patterns, the better you can anticipate the market's next move, giving you the advantage of entering trades with confidence and precision. To trade these patterns effectively, it's crucial to enter trades at breakout points or after confirming the pattern's validity. This approach helps ensure that you're aligning with the market's direction and not getting caught in a false move. For instance, when you spot a triangle pattern, whether ascending, descending, or symmetrical, the ideal time to enter a trade is when the price breaks out of the triangle. This breakout typically signals that the period of consolidation is over and the market is ready to continue in the direction of the breakout. By waiting for this breakout, you confirm that the pattern is valid and that the market is moving as expected, reducing the risk of entering too early. Similarly, with a head and shoulders pattern, you should wait until the pattern is complete and the price breaks below the neckline before entering a trade. This confirmation indicates that the reversal is underway and the uptrend is likely ending. Entering at this point gives you a stronger chance of capitalizing on the new downtrend. The same principle applies to other patterns like flags, pennants, and double tops or bottoms. Whether you're trading a continuation pattern like a flag or a reversal pattern like a double top, entering the trade at the breakout point or after the pattern is fully confirmed ensures that you're following the market's momentum. This strategy helps you avoid false signals and increases the likelihood that your trade will be successful. By focusing on breakout points and confirmation, you not only validate the pattern, but also position yourself to take advantage of the market's next big move. This disciplined approach to trading chart patterns enhances your ability to make informed decisions and improves your overall trading performance. Using stop-loss orders is essential for managing risk and protecting your capital when trading chart patterns. By placing your stop-loss just beyond the pattern boundaries, you can limit potential losses while giving your trade enough room to work. For example, if you're trading a head and shoulders pattern, it's wise to set your stop-loss above the head's peak. This ensures that if the market unexpectedly moves against you, your position will be closed before the losses become significant. This placement protects you from the risk of a false breakout or a sudden reversal that goes beyond the expected range of the pattern. The same principle applies to other patterns like triangles, flags, and double tops or bottoms. If you're trading a triangle, place your stop loss just outside the triangle's bound, directly above the upper trend line in a descending triangle or below the lower trend line in an ascending triangle. This way, if the breakout fails and the price moves back into the triangle, your stop loss will limit your losses. In the case of a flag or pennant, position your stop loss just outside the pattern's boundary on the side opposite the breakout direction. For example, if you're trading a flag in an uptrend and the breakout is upward, place your stop loss below the lower boundary of the flag. This protects you if the price pulls back unexpectedly. By strategically placing stop loss orders beyond the pattern's boundaries, you safeguard your trades against unexpected market movements. This risk management technique helps you maintain discipline in your trading and protects your capital, ensuring that you can continue trading even if a few trades don't go as planned. It's a critical component of any successful trading strategy, helping you to minimize losses while maximizing potential gains. In our Trader Pro, setting up a stop loss order is straightforward and essential for managing risk. Start by selecting the stock or futures contract you want to trade. Once you've chosen your asset, go to the order options and select Stop Loss Order. Next, enter your trigger price. Is the price at which you want the stop loss to activate if the market moves against you. By doing this, you ensure that you have a safety net in place, protecting your position and limiting potential losses if the trade doesn't go as expected. This simple step helps you maintain control over your trades and keeps your risk management strategy solid. Now, let's delve into market limit and stop limit orders. A market limit order is a powerful tool that ensures you execute a trade at a specific price or better. This type of order gives you control over the price at which your trade is executed, which is crucial in managing your entry and exit points effectively. For example, if you're looking to buy a stock and you've determined that $50 is the ideal entry point, you would set a limit order at that price. The order will only execute if the stock reaches $50 or drops below it, ensuring that you don't pay more than what you've decided is acceptable. This approach is especially useful in volatile markets where prices can change rapidly, as it guarantees that you only enter the trade at the price you're comfortable with or better. This kind of precision helps you stick to your trading plan, ensuring that your trades align with your strategy and risk tolerance. Stop limit orders are a versatile tool that combines the features of both stop and limit orders, allowing you to trigger a trade at a specific price within a set range. This type of order offers more control over the execution price, making it ideal for situations where you want to sell or buy within a particular price window, avoiding execution at prices outside your comfort zone. For instance, let's say you hold a stock and want to sell it if the price drops to $48, but you're not willing to sell it for less than $47. In this case, you would set a stop limit order. First, you set the stop price at $48, which triggers the order when the stock reaches this level. Then you set the limit price at $47, which ensures that the order will only execute as long as the price remains above this level. If the stock price falls to $48, your order is triggered, but it will only be filled if the market price is between $48 and $47. This way, you avoid selling at a lower price than you're comfortable with, providing a balance between execution certainty and price control. Stop limit orders are particularly useful in managing trades where precision is key, giving you greater control over your trading outcomes and helping to protect your positions from unfavorable market movements. Market limit orders guarantee that your trade will only execute at your specified price or better, but they do not guarantee that the trade will be executed at all. This means that if the market never reaches your limit price, your order will remain unfilled. This type of order is best used when you are focused on getting a specific entry or exit price and are willing to risk the possibility that the trade might not happen. On the other hand, stop limit orders offer a balance by ensuring that your trade is executed within a specified price range. While this type of order provides more control over the price at which your trade is executed, it also means that if the market moves quickly and skips over your limit range, the trade may not be executed. This makes stop limit orders useful when you need precise control over both the trigger point and the acceptable price range for the execution. Choosing between market limit and stop limit orders depends on your trading strategy and risk tolerance. If getting a specific price is crucial and you're okay with the trade possibly not being executed, a market limit order is the way to go. If you want to ensure that your trade is executed within a certain price range, but are willing to accept the trade might not happen if the market moves too quickly, a stop limit order is more appropriate. Understanding how to use these orders effectively can help you better manage your trades and align them with your overall trading goals. For example, if a stock is currently trading at $50, you might decide that you want to buy it, but only if the price drops to $49. In this case, you would place a market limit order at $49. The order will only execute if the stock reaches or drops below $49, ensuring you don't pay more than your desired price. However, if the stock never hits $49, your order won't be filled. On the other hand, if you're holding that same stock and want to protect yourself from a potential decline, you might set a stop limit order. For instance, you could decide to sell the stock if it drops to $48, but you're only willing to sell as long as it doesn't fall below $47. Here, you would set a stop price at $48 and a limit price at $47. If the stock hits $48, your order is triggered, but it will only execute if the price remains within the $47 to $48 range. This gives you more control over the exact price at which your trade is executed. This flexibility in using market limit and stop limit orders allows you to plan your trades more effectively, tailoring your approach to match your strategy and risk tolerance. By understanding and utilizing these tools, you can better manage your entry and exit points, making more informed decisions that align with your overall trading goals. Let's go over some practical tips for using these orders effectively, starting with the importance of confirming patterns with volume. Volume is a critical factor in validating chart patterns. When you identify a pattern, whether it's a head and shoulders, triangle, or double top, confirming it with high volume can significantly increase your confidence in the pattern's reliability. High volume indicates that there is strong market participation behind the price movement, suggesting that the pattern is more likely to lead to a sustained move in the anticipated direction. For example, if you spot a breakout from a triangle pattern, you'll want to see a significant increase in volume accompanying that breakout. This surge in volume signals that many traders are participating in the move, which adds weight to the breakout and reduces the likelihood of a false signal. Without this volume confirmation, the breakout might lack the momentum needed to continue, leading to a potential reversal or failed trade. By always checking the volume, you ensure that the price movements you're seeing are backed by strong market interest. This helps you make more informed decisions when placing orders, whether it's setting a market limit order at a specific price or using a stop limit order to manage risk. Volume acts as an additional layer of confirmation, giving you greater confidence in your trading strategy and improving the chances of a successful trade. Combining chart patterns with indicators like the relative strength, index, RSI, or moving average convergence, divergence, MACD can greatly enhance the accuracy of your trades. These indicators provide additional layers of confirmation, giving you deeper insights into market conditions and helping you make more informed decisions. For instance, if you spot a head and shoulders pattern forming on a chart, this is already a strong signal of a potential trend reversal. But to increase your confidence in this signal, you can check the RSI. If the RSI is in overbought territory, it suggests that the asset is likely overextended and due for a correction, which aligns with the bearish implications of the head and shoulders pattern. This combination of signals strengthens the case for a reversal and can prompt you to prepare for a short trade with greater conviction. Similarly, MACD can be used to confirm chart patterns. If you're observing a double top pattern indicating a potential reversal from an uptrend, look at the MACD for a bearish crossover, where the MACD line crosses below the signal line. This crossover, particularly if it happens near the second peak of the double top, reinforces the likelihood of a downward move, giving you an additional reason to consider entering a short position. By integrating chart patterns with these technical indicators, you add a valuable layer of analysis to your trading decisions. These indicators help validate the patterns you're seeing and provide context about the overall market momentum and potential turning points. This multi-faceted approach improves the accuracy of your trades and helps you navigate market movements with greater confidence. Setting stop-loss orders is a fundamental practice for protecting your positions and managing risk effectively. Having a clear plan for where to exit a trade if it goes against you is crucial for minimizing losses and maintaining discipline in your trading strategy. When you enter a trade, you should already have a specific level in mind where you'll place your stop loss. This level should be based on logical points on the chart, such as just beyond support or resistance levels, or outside the boundaries of a pattern like a head and shoulders or triangle. By setting your stop loss at these strategic points, you protect yourself from significant losses if the market moves unexpectedly. For example, if you're trading a double bottom pattern and you enter a long position, you might set your stop loss just below the lowest point of the pattern. This way, if the market doesn't perform as expected and breaks below that low, your position is automatically closed, limiting your losses. Having a stop loss in place also helps you stay disciplined. It removes the emotional aspect of decision making during volatile market conditions. Instead of holding onto a losing position in the hope that the market will turn around, your stop loss ensures that you exit the trade according to your plan, preserving your capital and allowing you to focus on new opportunities. By consistently using stop loss orders, you build a solid risk management foundation for your trading. This practice not only minimizes potential losses, but also supports your long-term success by keeping your trading strategy systematic and disciplined. Studying historical charts is an invaluable practice for any trader looking to improve their ability to recognize and understand chart patterns. By examining how patterns have played out in the past, you can gain deeper insights into their behavior and potential outcomes, which in turn helps you to spot them more quickly and accurately in real time. When you review historical charts, you get to see how different patterns, such as head and shoulders, triangles, or double tops and bottoms, have unfolded in various market conditions. This allows you to observe not just the formation of the patterns themselves, but also the price action leading up to and following these patterns. Understanding the context in which a pattern forms, whether it's during a period of high volatility, low volume, or a strong trend, can give you clues about how similar situations might play out in the future. As you analyze these past patterns, pay attention to the factors that confirmed or invalidated them. Look at how volume supported the price movement, how other technical indicators like moving averages or Bollinger Bands interacted with the pattern, and how external market events might have influenced the outcome. By seeing these patterns in action repeatedly, you start to internalize their characteristics and develop an intuitive sense of when they're likely to lead to a significant price move. The more you immerse yourself in historical chart analysis, the quicker you'll become at spotting these patterns in real time. This skill is crucial for timely decision making, allowing you to enter and exit trades with confidence. Over time, your ability to recognize patterns will become almost second nature, enhancing your overall trading strategy and increasing your chances of success in the market. Let's explore the tools and platforms that can help you analyze charts effectively. RTrader Pro is a standout platform that offers advanced charting tools and real-time data, making it an excellent choice for identifying and analyzing patterns. With RTrader Pro, you have access to a comprehensive suite of features designed to help you dissect market trends and make informed trading decisions. The platform's advanced charting capabilities allow you to customize your views, overlay technical indicators, and zoom in on specific time frames to get a detailed look at price action. Whether you're looking for classic patterns like head and shoulders or more complex formations like triangles and flags, RTrader Pro provides the tools you need to spot these patterns as they develop. Real-time data is another crucial feature of RTrader Pro. Having access to the most up-to-date market information ensures that you're analyzing the latest price movements, which is essential for making timely decisions. The platform's responsiveness allows you to act quickly when you identify a pattern, giving you the ability to enter or exit trades at the most opportune moments. RTrader Pro also supports the use of various technical indicators that can be combined with chart patterns to enhance your analysis. Whether you're using moving averages, Bollinger Bands, or volume-based indicators, the platform allows you to apply these tools seamlessly to your charts, providing additional layers of insight. Moreover, the platform's intuitive interface makes it easy to navigate through your analysis. You can quickly switch between different assets, compare historical data, and set up alerts for specific patterns or price levels. This user-friendly design ensures that you can focus on your analysis without getting bogged down by complex menus or slow response times. RTrader Pro offers everything you need to analyze charts effectively, from powerful charting tools and real-time data to a wide range of technical indicators. It's an all-in-one solution that supports both the novice and the experienced trader, helping you make informed decisions and improve your trading strategy. To set a stop loss in RTrader Pro, begin by selecting the stock or futures contract you're trading. Once you've chosen your asset, navigate to the order options and select stop loss. Then set your desired trigger price, level at which you want the stop loss to activate if the market moves against you. This action puts a safety net in place, ensuring that if the trade doesn't go as planned, your position will be automatically closed, limiting your potential losses and protecting your capital. For market limit orders, the process is equally straightforward. Select Limit Order from the order types available. Then input your desired price, specific level at which you want to buy or sell the asset. Once you've entered this price, execute the order. The market limit order guarantees that your trade will only be executed at the price you specified or better, ensuring that you don't pay more or receive less than your target price. This feature provides you with greater control over your trades, helping you achieve your desired entry or exit points with precision. To set a stop limit order in RTrader Pro, begin by selecting the asset you're trading. Once you've chosen your stock or futures contract, navigate to the order options and select Stop Limit. Next, you'll need to enter two key prices, the trigger price and the limit price. The trigger price is the level at which you want the stop order to activate, while the limit price sets the maximum or minimum price at which you're willing to execute the trade. After entering both the trigger and limit prices, confirm the order. This setup gives you more control over the execution of your trade, ensuring that it only occurs within the specific price range you've defined. By using a stop limit order, you can protect yourself from unfavorable price movements while still ensuring that your trade is executed at a price that aligns with your strategy. This balance of control and precision makes stop limit orders a valuable tool in managing your trades effectively. As we wrap up, let's take a moment to review some final tips and best practices to enhance your trading. We've covered the essentials of chart patterns, trading strategies, and key order types. To trade more effectively and make informed decisions, always confirm your chart patterns with volume. High volume adds credibility to patterns like head and shoulders, triangles, and double tops, indicating strong market participation behind the price movements. Incorporating additional indicators into your analysis is also crucial. Using tools like Bollinger Bands, moving averages, or the stochastic oscillator can provide deeper insights and help confirm the signals you're getting from chart patterns, giving you more confidence in your trades. Risk management remains a cornerstone of successful trading. Always use stop-loss orders to protect your positions. By setting stop losses just beyond key pattern boundaries, you ensure that you're limiting potential losses if the market moves against you, keeping your strategy disciplined and your capital safeguarded. By combining these best practices, confirming patterns with volume, utilizing additional indicators, and managing risk with stop-loss orders, you'll be well equipped to trade more effectively and navigate the markets with greater confidence. Apply these tips to enhance your trading strategy and make informed decisions. Practice spotting patterns, setting up trades, and managing risk consistently. The more you practice, the better you'll become at recognizing patterns in real time, executing trades with precision, and managing your risk effectively. Over time, this practice will sharpen your skills, build your confidence, and ultimately improve your success as a trader. Thank you for joining us today. Keep learning, keep trading, and see you next time.